Snowflake is down an incredible 32% over the last month. We're going to take a look to see if this is an incredible buying opportunity. As always, we'll look at their numbers, we'll look at their top line revenue growth, look at their net income to ensure they are growing at a very fast rate given their valuation. We'll also have a quick look at the health, their total cash versus their total debt. And we'll see how they're performing versus others in the industry, if they are at least performing above the majority. We'll also discuss some insider selling as some notable insider buying that we have seen just over the last few days. And we'll look at the institutions, whether or not they are buying on the more recent quarter after we found out that the CEO is stepping down. And we'll look towards their numbers, the free cash flow. We'll look at their sales growth and some metrics to ensure for the valuation, this still looks like an incredible opportunity. And we'll see whether or not Morningstar, who did release an article after their earnings, believe this is a buy or a sell, or if it in fact is fairly valued. And we'll take a look at both a bullish scenario for this company over the next few years, as well as a bearish. And don't forget, not only are we going to, in today's episode, run it through the valuation model to get to our intrinsic value, we're also going to look at our discounted cash flow model for a low, medium and high growth rate, so you can understand where these numbers are coming from and whether or not you do believe they will hit any of these criteria. So let's take a quick look at their historical performance. Now, they are down 32% over the last 30 days. We can see year to date they're in fact down 21%, and over the last year, however, they are still up around 13%. Now, when we take a look at the last 5 years, we can see listed in around September 2020 at $253. It did then peak a few times around that $390, $400 over the next few years. But we can see right now it is nowhere near their all-time highs, currently trading in the mid to lower end of the 52-week range with a market cap of $52.3 billion. Now, when we do take a look at their numbers, we expect for the valuation, as we saw here, the forward P looks incredibly high, very fast growth. What we can see, total revenues, $265 million in January 2020. Incredible growth, in fact, to their latest accounting period, January 2024, more than 10 times to 2.8 billion. And on top of that, year on year, we can see some very strong increases from this fast-growing tech company. Now, in terms of their bottom line, their net income, one thing we do want to point out is they haven't yet made a profit. We can see every single year they have reported we do have a net loss. And in fact, from 2020, it is moving in the wrong direction. There is an increase in the loss over the last few years, as we can see here. So something to consider. We will discuss that when we look at the financial metrics. Now, a quick health look, total cash versus total debt. $434 million reported on their balance sheet in 2020. Now, when we take a look at their latest quarterly report, $3.8 billion. So they have a large increase to their cash position. So it does look fairly healthy. But really, to conclude on that, we need to see their total debt numerically and directionally. $211 million increased to $288. In fact, their total debt position is incredibly small, much lower than their total cash position. So no worries, essentially, on this general overview of their balance sheet. And that should show when we look at the net debt to EBITDA metric. Now, comparing it to others in the internet services and infrastructure industry, we have Cloudflare, MongoDB, VeriSign, and a few others. What we can see over the last year, they are up around 13%. In fact, one of the worst performing in the industry, something just to bear in mind. And over the last 5 years, they are in fact the worst performing, down 38%. So yes, they have been very poor over the last few years, but always important to remember that past performance is not necessarily an indicator of future performance. Now, this is very interesting. We see a buy and a sell. What we typically say, buy signals are very bullish. Management obviously buy for one reason. They think the price will rise. We do know that with the director, Mark M, as we see here on the 6th of March, bought over 3,000 shares at $165, total cost of $500,000. What we do know since that, though, it is down around 5%. Interestingly, we see the CEO who is stepping down, Frank Slootman. He has sold a number of shares. In fact, this is just one batch of the shares he has sold. 211,000, as well as a few others, as we see here, the EVP, the President of Products, and the Engineering and Support Vice President. So we can see a lot of sales over the last few days. In fact, all these came on the 11th of March, so just 4 days ago. Now, selling isn't necessarily a bearish signal. They sell for many reasons, but again, we just want to point out we also see buys as well as sales. Just interesting to note there. In terms of institutional ownership, 64%, around 6 billion worth of sales over the last 12 months. A little bit more buying, as we can see over the same time period, 8 billion versus 6 billion. One thing that we also want to point out, over the last quarter, the more recent Q4 of 2023, there was more around double the amount of buying than there was selling, and we also note that for Q3, although in Q2 we see around the same amount of buying and selling, Q1 we see more selling. So overall, a little bit more buying than selling over the last 12 months. However, in the more recent quarter, institutions are very bullish on Snowflake. They have been buying shares. Now, before we jump into the financial metrics, we can take a very quick look at this article from Morningstar that was released after their earnings last week. Now, they have come to their own fair value estimate of $187, bearing in mind the current price is around $157. They give it a 3 stars in terms of value, with 5 being incredibly undervalued and 1 star being overvalued. They don't quite give it a moat rating, and they do give some of their discussion points on their earnings. As we can see, their results came in below the projections, with the miss mainly on the outlook of 22% growth, and what was expected was around 30%, hence why we did see this share price tumble quite dramatically, and the consensus there around 29 to 30%. Margins as well guided to decline over the next year. Never good, especially for those who have seen, for example, our Nvidia videos, where we do talk about how not only have they increased their top line revenue, but they are also increasing their margins year on year, which is very positive to note. Now, they also talk here about some fundamental weaknesses. This is essentially deriving from the fact that they are having pricing pressures and concessions. So there are a few things just to comprehend. One of the largest reasons, in fact, why the share price did dip was that CEO change that they are going to be having. So something just to consider. I do believe they are bringing in someone from Google, and we can take a look at that as well. In fact, when we do take a look, we can see here there is a new CEO in place. As we can see, he is an AI expert, or this is what it's proclaimed on this website, and he is a former Google executive. So it will be interesting to see how he does take command of this company after their huge drop. They have essentially lowered their guidance and margins are decreasing, with some expected headwinds on the way. We can see here a bullish and bearish scenario. So the bulls essentially say that they could remain the only multi-cloud offering of its kind for much longer than anticipated, so they can increase their top line, no essential pricing pressures, so can start to increase their margins. As we mentioned earlier, they are decreasing, and they could also look to move to more of a subscription model rather than just pay as you use. That will then obviously increase the monetization of their products, and they can also expand into other cloud data needs, increasing the monetization they are generating from their customers. Now, in terms of some bearish scenarios, just to essentially think about in terms of competing with others in the industry, whether that is AWS or Azure, we have from Microsoft, and they could also effectively fail to expand their data sharing network. Just a few things to consider. So as we did mention, one of the main things that we do see in terms of the issues, they're reducing their guidance. So essentially their top line revenue could be slowing down whilst also decreasing their margins. And right now they aren't profit making. So that is a few things to consider, and we will include that when we do look at our margin of safety. Now, just to let you know, we have released our latest free weekly article. If you want to gain access to that or any others, all completely free, do click on that pinned comment below, sign up, and you can gain instant access. Free cash flow per share, more positive. We do see it has gone from negative 388 to positive 229 in 2024. It is expected to increase again in 2025 to 298. So nice to note that whilst they did have 3 years of the specified time period in negative free cash flow, since then it has increased year on year and expected to continue in 2025. As we just mentioned earlier, their sales growth has been phenomenal and probably why they do have a very high valuation. It has slowed down. Nonetheless, whilst 36% is still very strong for 2024, as we mentioned for the forward guidance, it is looking around 20%. A little bit of a worry if you are bearing in mind that this is very highly priced in terms of the forward outlook if their top line does start to reduce very, very strongly. Total sales, however, has gone from 100 million to 2.81 billion, so it has increased over a very short time very rapidly. And also interesting to note, with shares outstanding, they have issued shares over the last 6 years, so they would have diluted your position as a shareholder if you were holding from 2019. No surprises, ROIC is negative every single year given they haven't yet made a profit, so something just to consider if this is a turn-off and it isn't something that meets your investing criteria. Operating margin, it is nicer to note that actually whilst it is negative, it has been decreasing year on year. I would like to see a much sharper decrease though. From 23 to 24, it only really moved by 2 percentage points. Free cash flow, a little bit of a different story. It has moved into the positive, and the last 2 years looking at some very strong numbers. Really, we want to see a minimum of 5%, which they have hit in 2022. So the last 3 years on the free cash flow margin side are looking more positive. And one thing that is important to remember when looking at the net debt to EBITDA, that is the earnings before interest, tax, depreciation, amortization, is that over the last 3 years, it wouldn't even take them 1 day to pay off all of their debt net of cash on hand, and that is expected in 2025, so they do have a very strong balance sheet. Now let's jump into the valuation, and as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, for today's episode, we are using the DCF model. We have the free cash flow year on year. Average growth rate, incredible at 74%. Now, we've gone for 30%. Now, we would say this is probably on more of the medium side. So we use that 30% with a discount rate to get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get an intrinsic value of $202. So we do have an undervaluation signal. Now, for those who believe that it should be lower than that, we do have a lower figure here of 25%, and we can see that would give an intrinsic value of $148, implying a negative upside, so downside essentially, of 5%, whereas the 30% would give upside of 29%. We also have a high estimate for those that believe it will be higher than 30%. At 35%, we can see this would be essentially $274, an upside of 75%. Remember though, this means that you expect 35% increase to their free cash flow year on year for a sustainable amount of time, something just to consider. Personally though, we have gone for what we believe to be the medium at 30%, and on top of that, we will also use a margin of safety. So we take this to the intrinsic value calculator, which is essentially for today's episode of Snowflake, just the DCF valuation. And don't forget, you can grab a copy of this model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio or those on your watch list. So we start off with a margin of safety, as always, at 10%, and we use that if we believe it meets 3 criteria: wide moat, strong financial metrics, and good forward-looking data. So we can see if you believe that, it's a buy up to $182, and then we keep going until it's near the current trading price. And we can see for today's episode, it isn't quite at a 25% margin of safety. It sits at around 20%, meaning a buy up to $162. Now, Wall Street, in their projections, they see the share price going up higher than our intrinsic value to $213. They see this as a strong buy now with upside of 36%. But remember, there are different scenarios just to bear in mind. Their top line revenue guidance was lower than what the market expected. We did see on their revenues, a year-on-year percentage-wise, it has been coming down. Last year, around 36%. They're expecting around 20% next year, which it is in a downtrend. And on top of that, not only is the revenue growth slowing, but the margins are dropping as well, and they haven't yet turned a profit. So lots of different factors to process before you do consider your margin of safety level. Now, for those, as we said, at 25%, you would be looking at a buy of $152. At 30%, around $141. Again, it does really come down to your investment process, your investment thesis, your risk profile, and maybe a lot of people will not want to invest in a company until they have turned a profit. So lots to consider. As always, do let me know your thoughts in the comments below, whether or not this is one you're looking to add. Maybe you're sitting on the sidelines waiting for some time for the CEO to just get into his role and see where he takes the company over the next few quarters. Or maybe you're just passing this company. Let us know, and don't forget, if you enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.